It is Monday, March 23, 2026. A 48-hour geopolitical ultimatum has just expired, and 95% of all maritime traffic moving through the Strait of Hormuz has come to a dead stop. The immediate cause of the blockade is a directive from U.S. President Donald Trump: reopen the strait immediately or face the systematic obliteration of Iranian power plants. In response, Tehran has established itself as the epicenter of a widening standoff, threatening retaliatory strikes against the electrical grids powering U.S. bases and allied infrastructure across the region. The physical toll is already mounting. The International Energy Agency has verified severe damage to 40 energy assets spread across 9 different countries. With global energy security abruptly removed from the board, institutional risk tolerance has simply evaporated. Supply panic has driven Brent crude oil violently up, crossing $110 per barrel. This chart shows the India VIX, a metric measuring the market's expectation of volatility over the next 30 days. On this Black Monday, the index has surged over 15% to a peak of 26.32, signaling extreme fear among investors. We are watching a stagflationary pincer in real time. On one side, $110 oil destroys corporate margins. On the other, it threatens to derail central bank inflation targets, forcing them to keep interest rates high while global equities fall. Capital searching for a safe haven is pivoting almost entirely into cash. Specifically, the US dollar index, or DXY, which tracks the dollar against a basket of foreign currencies, is holding strong above 100.18. Macroeconomic conditions have trapped institutional capital, triggering a massive mandatory sell-off of growth-oriented assets. The Arab markets sit directly at the geopolitical epicenter, leading to extreme divergences. They are functioning simultaneously as energy beneficiaries and direct targets. The Saudi index, the TASI, is displaying a rare resilience. Fueled by the prospect of massive fiscal surpluses from expensive crude, it has formed a bullish pennant pattern holding support at 10,800. By contrast, the United Arab Emirates ADX index is barely holding a fragile floor at 9,450. Traders are aggressively pricing in the physical tail risks of missile debris landing in residential and commercial hubs. This shockwave is expanding rapidly into Europe, driven by a historic liquefied natural gas supply shock after the critical exports from Qatar's Ras Laffan port were completely blockaded. This candlestick chart of the German DAX shows the index breaking down into a bearish pennant structure, capped by a hard resistance ceiling at 24,100. Markets bet this imported energy inflation forces the European Central Bank into an emergency rate hike. The severity of institutional capital flight from a given region is being dictated almost entirely by its reliance on maritime supply chains. Over in Asia, the structural vulnerability is even higher. As a massive net energy importer, Japan's TOPIX index plunged 3.5% today. Meanwhile, the Shanghai Composite has snapped its primary ascending trendline, officially dragging the Chinese index into a bear market. Now the shockwave has reached the core of the global financial system. In the U.S., rising energy costs make a hawkish hold, where the Federal Reserve refuses to cut interest rates, highly probable. This geometric overlay on the Nasdaq demonstrates a clear descending triangle pattern. The 24,000 mark is the final line of defense for tech stocks. Meanwhile, the Dow Jones is testing its 200-day moving average, a critical institutional indicator. A breach here triggers automatic liquidation. And the narrative of cryptocurrency acting as a safe haven has evaporated. Bitcoin has slid down to $69,414. Behaving exactly like a high beta proxy, meaning it's swinging downward even harder than the broader equities market. With sovereign wealth funds systematically dumping supply, the central pillars of the global financial architecture are buckling. To see how domestic defense attempts to fight off foreign capital flight during a global shock, we can look at a live tug-of-war playing out inside India's Nifty 50. This comparative chart tracks institutional flows. As oil spiked, the Indian rupee crashed to a record low of 93.71 against the dollar, prompting foreign institutional investors to dump over 5,500 crore rupees worth of equities. But domestic institutional investors stepped in to absorb the blow, executing over 5,700 crore rupees in buy orders to perfectly counter the foreign exit. Yet, despite this massive domestic buying absorption, the Nifty 50 still slumped by 607 points, crashing right through its critical support level at 22,700. Robust domestic liquidity can cushion a fall, but it cannot insulate an emerging market from the sheer gravity of a $110 oil shock. For traders, the immediate reality is clear. The structural bias across all global indices has firmly shifted to sell on rise. The only viable tactical shelters are public sector oil companies and specific IT firms that have shown resilience against the dual currency and energy shock. This zoomed-in chart of the Nifty Index highlights a massive wall of supply at the 23,000 resistance mark. If the index closes below 22,500, it opens a trapdoor straight down to the 22,000 psychological floor. Until the 48-hour ultimatum resolves and maritime traffic resumes in the Strait of Hormuz, this war premium is locked into the tape. The market is demanding extreme cash preservation.